The big question on everyone's mind is this inflation surge that we've seen as of late because of energy prices, whether that's something that the market is discounting, and more importantly, whether it's something the market should be discounting.
Well, what has happened is interesting, is it's changed real yields more than it's changed inflation and break-evens. Obviously, the oil increase is inflationary, and we've seen that rise. But if you look at the decomposition of interest rate increases, it's really about changing the perspective on the path for Fed policy rates. And that tends to track the real interest rates more. And so that's really what the implication in the short run has been all about. We came into the year pricing 2 cuts. Now we're pricing 1 hike. So the shift in terms of the oil prices and the impact on the war for monetary policy has really been to take away this kind of normalization trajectory that we had started the year on.
But it raises a lot of questions as to why, at least the equity market is sort of looking past this. The idea that you still have a near record rally for most of the indices here on this day, despite some of those concerns lingering out there. And I know it's a narrow rally. And you don't necessarily see the same sort of song and dance coming out of the bond market. And I am curious as to whether they're singing different tunes right now.
Well, I would say that the bond market, and especially interest rates, are really much more about the earlier conversation: monetary policy, the outlook for the Fed, inflation, and obviously the changes there. The equity market, and as your earlier segment just talked about in terms of concentration around earnings momentum, this is about AI momentum. And it is about the macro story that is permeating everywhere. It's a micro story in individual companies, but it is now the macro story for the macro economy as well. And it's powering suddenly or unexpectedly strong economic growth, because we're seeing it less from the consumer side, although that's getting a benefit from the wealth effect from financial conditions, but you're seeing it on the equipment and on the investment side coming through here. So AI is everywhere, and in that sense, you're seeing kind of a consistency between the bond market and the equity markets.
Interesting, and I want to talk about how that all folds into that ETF that Romain mentioned that you manage. The ticker there is IALT. And of course, when you take a look at your universe, it's equity, it's fixed income, it's commodities, it's currencies, the list goes on, liquid alternatives. And, you think about those different narratives, you do see, actually elements that fixed income and equity are still responding altogether to that AI theme. But it feels like there's been a lot of different cross currents. There's been a lot of different catalysts in terms of what drum the fixed income market is drumming, I don't know what metaphor.
Drumming, beating, spiking the football.
Walking. Anyway,
yeah.
It feels like, for fixed income, specifically treasuries, it's been more about the macro. It's been more about AI, classically, when you take a look at just equities. How do you fit this all together into a portfolio that is multi-asset in nature? So
IALT, we call it, is really a solution to some of these big macro trends that we're talking about. In the equity markets, it's a little bit of too much of a good thing can be a bad thing. And while we're getting great index performance, those indices are becoming more and more narrow, right? So you think about things like your momentum comment, you think about the top 10 companies, you think about the incredible rally that we've seen in semis over the past couple of months. These are powering aggregate increases, but it's also creating a lot of concentration and challenging the concept of diversification. So when we think about IALT and where it fits within the portfolio, it's about providing another form of diversification. Equity markets are more concentrated. And when we talk about that macro story of inflation and the oil impact, we saw in March the loss of typical bond diversification to equities. Equities and bonds both went down on the surprise, unexpected inflation. So IALT in the liquid alternatives, it's an alternative strategy, and it delivers diversification because the strategies that it pursues are market neutral. So we're taking out market direction and giving portfolios a differentiated source of alpha as a source of diversification.
Well, let's talk about the last 3 months, because we are approaching that 3-month anniversary of when the war actually broke out. How active have you been in managing this portfolio, in shifting your allocations, especially as you do see some of those correlations break down, as you mentioned, but then maybe come back a little bit?
Yeah, well, so it's really important to understand what IALT represents for the ETF universe. Most of what you see in terms of investment opportunities are plays on markets or access. mostly what you're getting in that sense is beta access. And so when you're managing a fund that's primarily beta, your question is relevant. Like, how are you moving your exposures? What's your stock exposure? What's your bond exposure? In this strategy, it's much less about beta and much more about alpha. And what does alpha mean? It means balancing long positions with short positions at a very highly differentiated and diversified way. So when it comes to those big shifts that you're seeing typical beta managers have to navigate, we kind of take that off the table. We're not trying to navigate around the big stock versus bond. Rather, what we're trying to do is take out the directionality through long, short, market neutral investing. And so what this looks like is a lot of very small positions across the equity landscape, across the macro landscape, where we're both long and short, similar securities, different, similar enough to take out the market exposure, different enough to capture the alpha. And by doing that, we didn't have to navigate big shifts over the 3 months on the beta side because we really don't have that beta exposure to begin with.